Another Monday and another episode. We are back. We're back in our places as well. From traveling to being here to being there to being some incredible guest podcasts. Rob had spent a long month on the road. I've been living my best life in Phoenix here, as one does, but going to some conferences here and there. Just got back from Houston. But we are back to another episode of the Lone Star Podcast. My name, Craig McGrouther, the Director of Business Development, co-host to the show, the Lone Star Capital Podcast, alongside the founder and CEO of Lone Star Capital, the one and only Rob Beardsley. I hope you're having a great day today. I'm sure the weather is incredible in New York, just brisk enough for your Russian blood to enjoy it. We're very excited to talk to you guys today about a couple of things. This show is going to be brief and brilliant, but many people on the show had said that we're never going to do our summit event again. They said that we couldn't one up it. They said that we couldn't make it better. Well,
I don't think many implies more than one. So you're kind of
we're making this larger than life, Rob. That's what you have to do in sales. It's called puffery. But in all seriousness, someone on the show may or may not have said we're not going to do the summit or the New York Summit. Some people have said that. Okay. Some people said the opposite, that we're going to make it bigger and better. We'll let you figure out who said that. But that said, we are very pleased and proud to announce that we are, in fact, going to do the summit for the fifth time in history. Fifth time, count them, 5, in the One World Trade Center, my office. The guy who keeps the lights on there, me. We're going to be having the event for you. Okay. September 14th and September 15th. We are absolutely thrilled to make sure that you can come. So we're promoting this early. And we're actually going to one-up this event. The format will actually be a skosh different this year than years prior. We're changing up some restaurants. We're changing up some scenery. We're actually changing up the agenda to make it more jam-packed and better than ever before. So I think this will be the best iteration possible of this summit event. So I'm absolutely fired up. So get your calendar out. The 14th, the event's going to start. The one, the only Sam Morris will be giving a keynote and presenting to the group. That'll be very exciting for those who obviously know us, know the firm, know that Sam is our newest member and partner. He will be incredible to give a presentation there. We're very grateful for that. And then the next day, it's going to be glorious. We're going to have the best breakfast you've ever had at a conference of all time. And we're going to have a very special speaker. We'll let you know about the changes in the iteration. But Rob, can we share, or is it too early? Can we give everyone a little bit of insider information about this incredible speaker that we're going to have? And I'm not talking about you or the other people that usually speak. But Rob, who is presenting this year that's a little bit different, a little bit unorthodox, that we're super proud to announce and share?
Yeah, I can't wait to announce this. We didn't force this. It just happened totally organically. As you mentioned, I thought that maybe we wouldn't host the summit this year because I felt a little burnt out and didn't want to do all this work for this amazing event.
That everyone benefits potentially more than us, but we do it for the people because we are, the men of the people.
It is what it is. And so we decided, my arm was twisted. We're doing the event again. And we thought, okay, do we have to have a fancy big speaker? Maybe we do, maybe we don't. But we had an amazing meeting, serendipitous meeting with Paul Hutchinson, the founder of Bridge Investment Group, which he helped scale that company to $20 billion in assets under management. He's a very interesting guy. Sam Morris, our partner, has a man crush, a self-proclaimed man crush on him. And we had a great meeting with him. And so he's going to be a fantastic speaker for us. He's going to share his insights, scaling Bridge Investment Group to 20 billion AUM. And then he's also going to pivot and talk about his latest passion project, which he's been focused on for almost a decade, which is his Children Freedom Foundation, something like that. But he'll be telling us all about it. We'll be fundraising for it. We'll be making donations. It'll be a fun time. It'll be maybe a little bit of a tearjerker, heartwarming time.
Yes, so you may know Bridge, as you mentioned, but we're kind of bearing the lead as to this. He produced the number 1 movie of all time in the independent space. The movie is Sound of Freedom. So if you've seen that movie, it's about child trafficking, a very, very scary and sad topic that has unfortunately plagued many places of the world. And we want to do our part to shine a light on that and to donate and make contributions to it. But as I mentioned, we're always trying to do something a skosh different every single year. How can we kind of pivot? How can we iterate so you can kind of keep coming back and forth where you're still going to get the immensely high level quality product, which is the conference, but how can we have a speaker come or another person come to kind of really level it up and make it more interesting than ever before? And Paul, the producer of Sound of Freedom, with his personal side, with business side, is definitely a gentleman who you can certainly put in that category of X factor of just being very high level and interesting. So we're very thrilled that he'll be coming to present. Rob, can you also share some other iterations that are very exciting as well, pertaining to the conference this year that might look a little bit different than the year before?
Yeah, I'm not sure what's finalized or what's appropriate for us to share yet, but we're kind of putting all the final touches on the event. It's, of course, going to be September 14 and 15. So it's around the corner, but there's still plenty of time. We haven't even formally announced it, but with event planning, it's like you got to plan a year in advance. But it looks like we've locked up the Cipriani Ballroom as the evening affair on the second night, on the main night. That's going to be really, really incredible. It's going to feel luxe. It's going to be luxe. It's going to be a great space, great experience, great food. It's going to be awesome. So that's going to be super fun. I'm looking forward to just, reconnecting with everyone like last year and also seeing some new faces, introducing more people into the Lone Star ecosystem.
Yeah, no, I think the event there at that space will be very special. It'll be very unique. It will be high end and it's just different. We've done Reserve Cut every year basically to this point, and we're going to kind of pivot from that move. We've enjoyed it, but we want to kind of give people a different flavor. And also those who come to New York City, maybe not that often, you've heard of Cipriani before, maybe. Cipriani is a very, very notable restaurant. There's many of them. So this will be a really, really great look for us. We'll also be able to, facilitate, I think, a better cocktail hour before the dinner and such. So this is very exciting. Any other color commentary you wanted to add there?
No.
Yeah, well, we're going to also do more workshops as well for this event. I think we're going to take out the Shark Tank pitching. So it can be better content and more one-on-one kind of work there, if you will. So we would love for you to come. We are also very conscientious of the fact that the market is pretty tough right now for a lot of people. So we've made the ticket price not cheap by any means, but a little more palatable. So if you want to learn more about that, this is basically an application process only to come. It's not just open to the general public there, if you will. But if you want to learn more about the event, work with us on it. If you want to sponsor potentially, let us know. Reach out to me via email. It's craig@lscre.com. Once more, CRAIG@lscre.com. And we'd be happy to send over that information to you accordingly. But yeah, we're thrilled. As I mentioned, we just spent about an hour and a half going through the roster there, if you will, of invitees and stuff, speaker options, stuff like that. So you're really not going to want to miss out on this opportunity. It's going to be a great event. We're super thrilled about it, and we are looking forward to hopefully seeing you there. The event dates are September 14th and 15th. Excellent. Now, on to something that is very compelling. I would definitely consider it in the thought-provoking category. And, well, Rob, I'll let you lead the way because I don't know how much you want me to say or not. But since this is your channel, your company here, I'll let you dance the line.
Sure. Yeah. I don't know. Are we going to get ourselves in trouble here? But no, I think this is all fair game and a fair topic. But essentially, what's bringing about this topic is we had found out or heard about basically a sponsor in the industry similar to us raising capital and offering very favorable splits on the profit share to their capital raising partners. Now, that's nothing new. We've heard about that. Obviously, it's a competitive market. If we offer X price and someone wants to offer X minus something, that's their competitive advantage to try to not even necessarily undercut the market, but just be more competitive and hopefully get business. But this is a very odd situation. And I don't want to focus too much on the specifics because I just want to speak more about the general dynamics of something like this. But in this specific circumstance, you have a very big sponsor with a big established network of investors, good brand.
Couldn't be that established anymore.
And this person and this group is offering a situation where they're actually offering a profit split, but this is not a profit split at all, because a profit split typically is something like 70-30, 70 to the investor, 30 to the manager, or 80-20, 80% to the investor and 20% to the sponsor, or even 90-10 if you want to go crazy and really discount yourself as a sponsor. But in this case, it's something a bit different. It's 100-0. So it's not a profit split at all. Essentially, the investor or the capital raiser, the fund manager, the fund of fund is looking at getting 100% of the profits, and the sponsor is taking a 0% profit share. So I think there's so much interesting about this, not even just specifics, but just generally speaking, because basically it all of a sudden kind of flips the whole dynamic on its head, and it causes someone to pause for a second and think, wait, this whole time as a fund manager or as an investor, I've been trying to extract the best deal from the counterparty, whether it be sponsor A or B or what have you. So it's in the investor's incentive to get, let's say, an 80-20 split instead of a 70-30 split. But then all of a sudden you hear, oh, wow, I'm being offered a 100-0 split. It should make you pause, and it is giving people pause, and they're thinking, okay, why? What's happening? And also, is it a good thing? Like, yes, maybe on paper I have won because I've extracted the best deal I could possibly get. So on paper I've won, but have I really won? Because now I'm signing up for a relationship dynamic where the steward of my capital, the person who's going to work hard for the future success that I'm banking on, has no incentive in that future, has no stake in that future. It kind of reveals the perverse or just the issue involved with these splits when you discount yourself too cheaply, right? So it's taken it to its logical conclusion and to its absurdity, essentially. And you understand, wow, why would I invest with a sponsor who cares so little about the upside that they're willing to give it all away? And it
Can I,
actually, yeah.
yeah, can I interject here? So not only is everything you said 100% true, let me piggyback off that once more. Rob, you are a CEO, and that means you deal with hirings and firings. Would you say that good talent generally wants to get paid good money or great money?
Oh, wow. Yes.
So great talent wants to get paid great money. I am very good friends with Rob. He's my best friend, but I'm not working for free. And that was always the expectation. I'm not doing this because I don't have great work options. I actually have incredible work options. I could have done a zillion different things and made a ton of money, but this is the choice that I made because guess what? It was the best combination of lifestyle, but also compensation. Where am I going with this? If you are working with a group that doesn't have promote, do you think, or is going to give that much away, do you think that they're going to have good employees? Because good people are not free. They're not cheap. They want to make money. I want to make money. I want to make money with you. I want you to make so much money that the byproduct of that is that I get paid a lot too. So if you want to have very good employees and very good talent who end up getting you the best result possible, you want to pay them. But you don't get money from nowhere. Money comes from somewhere. It comes from the deals, comes from the back end. So what do you think the quality of talent looks like for these groups that offer not as good of splits? I'm sorry, but the talent will have to diminish. The groups that probably defend it the most probably have employees that respect themselves most and probably are doing really good things that in order to kind of gain that split that they have there. So I want everyone to be thinking about this. There's no free lunch. No one is in business for free. No one is buying deals that are, call it $30+ million for generous thank you so much pricing. That does not work that way. That's not how this game works. There's no free lunch. There's no easy way around this game. Okay. So if someone is offering very, very generous splits, it's because they probably don't believe in the deal or they may not have good talent around them. And you want the best people in the world. My haircut, it's not cheap. It's probably one of the more expensive haircuts to have in the city. Now, you could argue if it looks good or not, but I'm going to pay the best for that. My golf instructor, probably the most expensive person there. My dad, probably not a cheap financial advisor. Working at Lone Star, it's probably not cheap, but guess what? You're going to get a very, very great product working with the best people. So you get cheap, you get what you pay for. So that's a little bit of a tangent there, but just think about this right now. This money has to come from somewhere. People are working. If they're working for nothing, well, then what do you think their employees are going to be like? And the other thing to ask yourself as well, and this is more of a tangent to the tangent, which is imagine if you're working with a group and they are buying a new deal and they're bailing water out because they've got legacy problems, meaning deals before they're capital calling or whatever. Maybe they're not going well. Well, a couple months ago, or I even say over a year ago, all of a sudden we started getting flooded with people from different companies that were, higher up, kind of applying for analyst jobs or kind of basically almost entry level work jobs, or people reaching out to myself looking to get into investor relations or, acquisitions, whatever, right? They were leaving their company. Why? They were leaving their company because they knew that there was no upside for them to be captured, either because they weren't going to buy more deals and they couldn't raise, or every deal that they had no upside or promote or bonus on the back end for them to work for. So they're basically just spinning the wheels for an hourly when they were looking for a group like us who actually had millions of dollars on the back end to be paid out and promote back end compensation for these deals, which if you're in the private equity space, you make your money, or you should be making your money on the back end of these deals. And if you're not making your money as a sponsor that way, there's probably some problems within that underwriting or the kind of the organization of that going on there, where they're making money regardless of you doing well or not, right? But all that said, if you're working with a company that is not doing well, those employees might leave. That's a problem. And they might have been the reason why you got sold there to start with. You work with a company like Lone Star, guess what? Our top talent, we're only bringing on more. So you want to work with groups like that are in our camp, and I'm sure there's other ones out there, if you will, that are in a really, really positive spot. But there's multiple consequences to what I just mentioned.
Yeah, that's definitely a really interesting point that is a layer under what's happening on the surface. So yeah, just to kind of go back to it, right? If someone's offering you, let's say 100-0, or basically a situation where you're going to invest in the long term and they're going to be the steward of that long-term outcome, yet they're going to have no financial stake in that long-term outcome.
Why would they care?
Why would they care?
Why
It's
would
a
they
perverse
care?
incentive, and it's a short-term value extraction methodology whereby they can just convince you to get into the deal so they can charge short-term fees, pay themselves those short-term fees, and then also pay their employees their short-term fees, obviously. However, like you mentioned, though the best talent is very smart people. You're a smart person, right? The best talent, they're smart. And so they're going to see what's going on. Oh, wow, the company I work for is offering 100 zeros. The leadership of this firm doesn't care about the long term. And if I care about my own long term, I probably don't want to be here. And so that's going to cause, like you said, the best talent to kind of leave those firms. And this isn't just the case for people who are, let's say, offering 100 zeros, because I don't want to get too into the weeds as far as who or why is doing that. Because bottom line, there's basically only two reasons why you do such a 100-0 dynamic. Is one, you're really desperate, and this is by the only means in which you can raise money. And that's not necessarily a good sign either, because I mean, I get it. Maybe there's valid reasons to be desperate, like you're young and you're starting out. I've been there. Many of us have been there. The second reason is far more pernicious, is or just evil, is basically you're offering someone 100-0 where you're giving them all the upside, and instead you're just going to bank all fees. So you're going to basically put the risk of the deal's performance working out on the investor or on the capital raiser, and then the sponsor themselves will just make out like a bandit on guaranteed fees, which are not based on performance, right? So acquisition fees, asset management fees, etc. So both of those things are obviously not good. The best talent is going to see that. They're going to leave those companies. So yeah, that's a really interesting dynamic at play here. Also, another point to add to your point is, even if a company's not doing this 100-0 stuff, just having capital calls, just having issues where the firm is spending all of its time on kind of fixing legacy portfolio issues and spending less time on acquiring new property, spending less time on generating new value, new promotes, right? Or maybe because of the legacy issues, it's more difficult to raise capital for new acquisitions, right? Again, same thing. The best talent is going to see, a good director of acquisitions, they're going to leave. Ambitious young analysts, they're going to leave. Asset managers, they're going to leave.
It's the whole kind of absorption, if you will, there, where the best groups will get the best talent during times like this. And they'll just basically absorb more market share. They'll absorb more talent. So it just really think about why someone would be offering that. And it's just so funny. The old saying is like, if it's too good to be true, it probably is. Well, if they're offering you that deal, why would they ever be offering that? That means they probably can't raise capital. Which, would you want to work with a group like that? Unless, caveat, they're young, or they're in such a problem that all of their old investors and capital partners hate their guts. Therefore, they got to get out to basically the bottom or a new set of people, which that's an issue in and of itself too, right?
Call it the
So,
bag holder fund.
yeah, exactly. So why just really think critically here as to why it makes sense. There's no free lunch. Like, listen, we're on Wall Street, if you will. Like, I'm not gonna say we're sharks, but like we like money. And if anyone, if we didn't think we could make money on something, why would we do it? Like, why would someone do any of that stuff, right? It's really use your brain here and think about this. If that's being offered to you, why would you take that? Unless you're just kind of a greedy person. I don't know. Maybe you are. Maybe you are. I don't know.
It's not good.
Yeah. So that was kind of the moral of the story here. That is your prerogative if you're doing that in your sponsor. But if that gets out, we are going to talk about it.
So, but Craig, but wait. When I plug into my fund manager calculator, which you can download on our website, lscre.com, you can download our fund manager underwriting.
You may just get a call or email or text from me as well.
Yeah. So you can download our fund manager toolkit, or you can use your own fund manager calculator. And you say, wait, Craig, for this deal where I'm being offered 100-0, I'm actually projected to make 20% or 30% on the equity I'm raising. So if I raise $1 million, I could make 200 grand. All right. So
It's such a good deal, right?
It's a good deal, right? Shouldn't I do that?
Yeah. Well, you play the sensitivity to or here or there on a cap rate exit or rent growth, and that could be 100% of nothing, right?
That's the challenge, and this is something that we've been harping on a lot, I think, on this podcast and elsewhere. Is just percentages and things on paper are just that. You want not just the biggest percentage, because the biggest percentage could be a percentage of 0, and so that's not what you want. And first and foremost, you need to underwrite the deal itself to make sure the investment that you are putting your investors into is actually what's in their best interest, not something that you can make the most money on as effectively an intermediary.
You've talked about this, but you actually had a founder's insight on this, which is think like an LP when you choose deals, right? So can you kind of just real briefly summarize that point here as we wrap up?
Yeah. I've recorded a lovely video in Vail. It's a nice backdrop. It's 5 minutes. I encourage people to go find it on LinkedIn or YouTube or wherever they consume their content. And basically, I talked about this exact topic, which is, as a fund manager, you are a steward of people's capital, and you should be looking at deals from the perspective of actually investing in it, not what you could make from it as an intermediary and raising capital, and what fee can I get, and what's split for me, and what's in it for me. But actually look at it and think, okay, if this were my hard-earned dollars, would I invest in this deal? And then it forces you really to think pragmatically about the assumptions of the deal, about the risks of the deal. And even if you aren't, as a fund manager, putting in any of your own money into a deal, you are putting a lot of equity into the deal, because you're putting in your relationship equity, you're putting in your sweat equity, and those things are arguably more valuable than actual capital. So I just, that was my point in that video. I encourage people to really not get carried away with greed, basically, and think, oh, wow, if I can raise $1 million for this deal, I can make 20% of what I raise. Because especially when you talk about multifamily is a liquid asset class that is highly desirable to invest in. And therefore, you should not be compensated highly for raising money for something that is easy to raise money for on the spectrum of investments. So let me explain that more. Because investing with Lone Star Capital, just as an example, in what we do vanilla, for the most part, we do vanilla multifamily deals. They're easy to understand. They are generally lower risk, and investors...
It's not development.
It's not development. Investors want to invest in this, so it's easier to raise money for us or for our strategy than it is for, let's say,
venture capital,
investing in a pre-seed startup that is pre-revenue. Okay. If you can raise pre-revenue startup money, you should make more on your raise than if you raise for something like us, because you're raising kind of like a staid investment. Okay. And so that's the problem. If you are being offered pre-seed type compensation, pre-revenue type compensation for the dollars that you're raising into a multifamily deal, there's a disconnect there. Something's wrong. So that's the thing. Don't get carried away by greed. Understand that if you want to make 20% on the equity that you raise, you're going to have to go and raise for something that's far more difficult to raise for. It's going to need to be a non-consensus bet where the sponsor is genuinely desperate for the capital. Because if you're doing that in multifamily, that means the sponsor is desperate for the capital, not due to market dynamics, but due to idiosyncratic issues with themselves.
Well said. Well, I have nothing else to contribute to that. Do you have any other take you want to have while we're on the subject here?
No.
All right. Buy your tickets to the summit, everyone. They'll be coming out soon. We appreciate you listening. Buyer beware there, if you will. Realize that people are making money. It's very important. No one's doing this for free. No one's doing this out of the kindness of their heart. Don't believe the lies.
If someone's offering you 100-0, ask them what they're making on the fees.
Or ask them how their current deals are doing.
And then compare those fees to market rate fees. And if you don't know what market rate fees are, you probably shouldn't be investing or raising money.
And if you are in that camp, you can email me and I can help you out.
We would love to help you.
Help me help you. Help me.
Thank you very much for listening.